Mission failed. We'll get them next time.
In a time where we're seeing bank runs on the regular, my portfolio is not looking too hot. Let's go ahead and just rip the band-aid off. We're down a good 11.5% on the last month, and there haven't been too many places to hide within this portfolio, and I actually want to talk about Turtle Beach as the highlight for what's really been one of my, if not my single greatest financial disaster, at least within the stock world, where I've lost, I think, the most amount of money by a good margin now. And I do want to talk more about that. I have talked about it plenty of times in the past, both in a positive and negative light. So I think that'll be the main subject of this episode. But as you can see, there really wasn't anywhere to hide. I guess I could have thrown it in a couple stocks here with Meta and Smith & Wesson. They would have stayed flat, but it's been a very rough month for stocks, at least the last 30 days or so. If we go to the year-to-date view, it's not so bad. We're still up about 2.7% because there was that big January and I think early February were quite good for stocks, definitely in January. And a lot of that was led by Meta, which just popped off after its earnings a while back. But yeah, it has not been a very pretty time in the market, very red. So I guess if you're in the red, then it's been great. But when it comes to Turtle Beach, what's unfortunate about these numbers right here is that they don't even reflect the aftermarket drop that it just had in its recent earnings call. Now, I haven't had a ton of time to look into the earnings yet, but the stock is actually well below $6 now after hours, which isn't reflected on M1 Finance. It'll refresh sometime tomorrow morning. I'm filming this a couple days before the release of this episode. But as you can see, I've invested $20,000 into the stock at an average share price of just over $18, and we're now approaching $5.50 or something like that. I actually just checked, it's at $5.92 as of recording. And here's their earnings press release, just to highlight a few things, going down here to the full year summary, where net revenue was down quite a bit from the previous year, which was to be expected, but their net revenue in 2021 was almost $370 million, whereas it was only $240 million in 2022, so that's no fun, and that helped contribute to a net loss of about $60 million in 2022, compared to a gain, a net income of almost $20 million, $17.7 million in 2021. Now, a lot of this loss was attributable to selling off some pretty expensive inventory that they had built up. This has actually been a problem for many companies over the past couple of years, where they stocked up a ton, as much as they could, during that big supply shortage in all sorts of industries that we saw in 2020 into 2021. And now some companies, Turtle Beach included, are really facing the wrath of those decisions because they have all this expensive inventory that they're sitting on, and depending on how they accrue those things, they are now facing the losses on paper, even though really the losses were felt long ago when they actually made the purchase. Whatever the case, they lost a bunch of money, and the stock has not favored well during that time. Now, this begs the question, what next to do with Turtle Beach? And that is a great question, because there are quite a few things I could do here. I could double down. I could buy even more, even though I kind of doubled down a handful of times while the stock continued to march downwards over the last couple of years. And so far, so bad. I could just take the losses now, sell it off, and not worry about it any further, which is an option, though I would hesitate to do that since I see this as a cyclical stock where this is getting towards the bottom of the cycle, I would think. Who knows where the trough will actually be, but this is a cyclical company, as I've discussed in the past. And that was my biggest mistake. I made a lot of my investments into the stock during the top of its cycle. It's in a very cyclical industry, which is the video gaming industry. And yes, it has been growing pretty consistently over many years now, but it's still a subject to cycles, especially one that's pretty tied to consoles like Turtle Beach. They sell a lot of console headsets for consoles like the Xbox or the PlayStation and all those great things. But when those aren't selling well, Turtle Beach is going to suffer because of that, because they need those console sales for a big chunk of their business. And we saw some new major consoles come out a couple of years ago, and they benefited greatly from that. But there's time that passes between these console releases, as the companies then have to wait it out, which makes sense because the companies have to develop new consoles, and that takes time. So during that time, Turtle Beach has to do other things. And if they don't do other things, everything's going to suffer. The revenues are going to go down, the earnings are going to go down because they aren't able to sell those headsets. So they have been pivoting towards PC components, stuff that's outside of the console realm that should be a little bit less cyclical, one would think. But even then, you're still kind of at the whims of the big game producers to get people into video gaming, at least for the most part when we're talking about the entire market. But anyways, back to the options I have. The third option is to simply hold, coffee can the thing. Just hold it forever and see what happens. Maybe it goes to zero, maybe at 10x's, maybe at 100x's. We'll see what actually happens. That's kind of the third approach. And that's, I guess you could say, what I'm currently on, since I haven't bought anything since this news broke, and really haven't bought anything in quite some time with Turtle Beach. And really, I haven't done a lot of stock buying in the last year or so, and I've really just been consolidating my overall portfolio, not really doing much of the position, at least within the last few months. Maybe that'll change in the near future. And this is also getting me thinking about the rest of my portfolio. I keep reiterating it, at least in recent episodes, talking about my plans for this portfolio. I have been consolidating it, trying to eliminate some of the headaches, but really, to some level, all of these stocks are somewhat of a headache when we consider my other goals that I'm doing right now. Right now, I'm running a business. I just bought a carpet and steam cleaning business, and I'm putting hours into that every day. I have my career to focus on as well as a commercial real estate attorney. It's quite demanding. There are a lot of hours I got to put in. So it's a lot of things to focus on in my efforts to actually bring in money, bring in cash flow, to then be able to invest. And then how much time is left over, and how much time do I really want to spend towards my portfolio? So my thinking has been, I'll keep consolidating, and that way my time spent towards investing won't be so diluted amongst a bunch of different stocks and a bunch of different types of investments, or at least as diluted as before. And at the same time, I might be more incentivized to pay attention to individual holdings, and that ideally would make me a better investor into those particular holdings, since I can actually pay attention to what's going on. But even so, the total portfolio right now is only about 75, well, plus about $2,000. A lot of that was a special dividend from Equity Commonwealth recently. They just paid out a bunch of their cash pile. Not really sure what that's about yet. I'm curious as to what they're trying to do in the near future, which we should get some color on pretty soon, but that's really just a cash pile at this point. But all told, I have something like $77,000, $78,000 in value in this portfolio, or I should say in market value, because the intrinsic value could be all sorts of things depending on how you want to spin it. But my actual market value of this portfolio is the $75,500 in stocks in here, plus about $2,000 in cash. And all the margin has been cleared out of this portfolio, which is nice, since I don't have that sort of looming margin call threat, even if it was quite small because I wasn't super leveraged in this portfolio. But it is a nice feeling not to have to worry about that margin. But I do have plenty of other debts to worry about, and this $75,000 or $77,000 could be well served towards paying off a bunch of debt right now. I have some debt in the double digits in interest rate percentage, and I do plan on paying that down within the year, or at least a lot of it. So it's not as though I'm going to be facing a ton of interest costs if all goes according to plan, which the plan is always subject to change. And one of those changes I might make is liquidating this portfolio to either pay off debt or to roll it into something within my own business. For one, it would remove the distraction of having to pay attention to all these stocks, but it would also remove the stress of having some of that debt outstanding if I used it to pay down the debt. And something about that is quite attractive right now. It's been a very stressful time. There's a lot of things going on. It's been good. We're making progress every day, but sometimes when I see these earnings calls, it just feels like a distraction because we're talking about a $7,000 position. Meanwhile, I just poured $180,000 or so into this business that I'm now running. I have employees. There are more responsibilities there. There's more upside there as well. So it makes sense to put my effort towards that thing rather than this little holding right here. And it's just this weird sort of mental barrier that I'm really wrestling with more and more each day, trying to figure out what I should do. Maybe I wrestle with it more as the stocks go down. And part of me is saying, don't sell. They're cheaper than what they were before. Therefore, you're getting a better deal on it. But the fundamentals change during that time too. If earnings change, if the business changes fundamentally, of course. But I think you get what I'm saying. There's sort of a mental aversion to selling that I have, which it could be really great in some markets and could be really terrible in others. Or if I'm too stubborn to sell something that really isn't a good opportunity anymore, or at least it's not as good of an opportunity as that money could be put in a different opportunity, that's much better. But I have to imagine I'm not alone in this thinking that if you sell off stocks and roll them into something else, it's almost like you're taking a step backwards. Because you go from having this $78,000 portfolio back to zero technically, but I thought the whole goal was to get a stock portfolio to the point where you're financially independent just on the stocks. Doesn't matter what you do outside of them. Isn't that the whole goal? Don't you want to keep pouring money towards those stocks? And yeah, there's a lot of merit to that, and that's the reason I'm still invested in these things. But sometimes it might make sense to take one step backwards to then take two steps forward, because you'd have more clarity, you'd have less things to worry about, and you can really focus on the main issue, or at least the primary issue at hand. But maybe this is just the bear market talking, because I haven't sold yet. I'm not ready to sell at this existing moment, but maybe that will change in the near future. I do think I'm inching closer towards that as the weeks go on, because there's just more things that I really feel like this money could be used for that could put us in a better financial position, even if it means we'd get back into stocks pretty shortly thereafter. Just for now, with all the things going on, it might make sense just to kind of wind up this portfolio, at least in the short term, because in the long term, I fully expect to have a significant portion of my portfolio into stocks because they really are defense in my view. And once you get a certain amount of money, I think it makes a lot of sense to have a significant portion of that portfolio in defensive assets, things like real estate, things like publicly traded stocks, liquid securities, things that probably won't go to zero anytime soon, at least if you're picking well, if you're well diversified. That's kind of how I view stocks, more as a defensive asset, things that might go up with inflation, but don't really get a lot of real return after that. Sure, you can have great winners in the stock market too, but those are relatively rare. And when you already have a bunch of money, in a weird way, you're more tempted to just let the thing ride and let it keep going because you don't really need the money, or at least the money is not as life-changing as it would be if you didn't already have it. I guess that's something of a paradox when it comes to investing. But whatever the case, this has been a fairly disastrous pick for my stock portfolio. But maybe I just need to talk myself off the ledge a bit and wrap this video up. So if you like this video and you want to see future updates, be sure to subscribe since I put out a new episode of this series every month on the 15th. And whatever I do with the portfolio, I'll be sure to let you know.